Well, morning all. My name's Lawrence. So from this R&D, specialist in R&D and patent box tax relief. So essentially, those are the tax reliefs that are either going to give you, some rebates or tax savings, making advances on technology, or overcoming technical uncertainties. And obviously with patent box, it's about getting deductions from any IP that you register. So Dave, if you've got a patent secured, congratulations, you've joined an elite club. So it's good company to keep. And but what I wanted to do today was to actually really introduce our partners at Blue Peak, because after a few years of staying in our niche specialist area, we've actually partnered up with other specialists, albeit in different areas of tax. And I think after today's call, you can see that it's not really just tax advice, it's consultancy, it's business development as well. So what we've prepared today are some anonymized examples of advice that we've been giving recently that is either helping people get higher company valuations, proper optimization of their tax liabilities, and just generally giving them better tools to run their businesses on the daily. So if we miss anything while we go through with some questions at the end, you can always schedule, other one-on-one calls afterwards. But I'll pass over now to one of the team over at Blue Peak, who are fantastic partners to work with, and certainly add a lot of value to our existing clients at this R&D.
Perfect. Thank you, Lawrence. So good morning, everyone. My name is Sam Elliott, and I'm the practice manager at Blue Peak. And we're really excited about the partnership we have with this R&D, being able to provide a wider suite of specialised services to our clients. The couple of things I wanted to talk about today were some recent pieces of advice and kind of work we've done with some clients to kind of highlight the value of having an accounting partner that is more the finance partner, more than your traditional statutory reporting accountant and just purely compliance. So the first one I want to talk to you about was a bakery that we've been working with that's fairly new, less than 2 years old, that had built a great reputation to the point that they had people queuing up outside the front of the door every morning. They were looking to really capitalise on their popularity and expand, but their profit was way below the targets they had set, regardless of the popularity they had, and actually meeting and exceeding their revenue targets. They just weren't getting the return they were expecting. And it was a case that we spent a number of meetings, quite a bit of time with them, understanding the business, working on some detailed management reports, looking into the individual transactions line by line, the different products they sell and the profitability of them. We were initially looking for kind of wastage, maybe an error in their calculations of what they're looking for profitability. And actually what we found with the space of just a couple of reports produced and a couple of months of working together, it was actually a case of there was someone in the team that had been adding some extra orders in to sell as a side hustle at markets on the weekend. And having that time together and looking at it proactively rather than just at a year end, maybe a year or 2 years down the line, has meant they've got their targets, has meant that they can start pushing again to that expansion while they have the popularity and while there's this bubble around them. Another one I wanted to talk about was actually kind of the opposite end of the spectrum, was an experienced business leader who'd been leading their company for 30 years, had complexity with some personal tax issues, and so had come in to speak in detail about those. And as part of those conversations, it came to light that they had previously successfully claimed R&D tax credits, but they didn't realise that future development and future iterations of their software, or actually a new version of the software altogether, might qualify for R&D in the present, and also looking at their plans to exit the business in the near future. They were under the impression that they were going to get hit quite heavily for tax. And it was the case of working with them quite closely. We think in the case of a month, we probably spent 2 whole days just in conversations with this one guy. We're now in a position where a successful R&D credit claim has been submitted, the funds have been received. This was a previously unexpected 6-figure reclaim that came into the business. And we're now looking at an employee ownership trust as a potential route for exit, providing a way for the management team, the existing staff, to buy into the business, and what should be a tax-exempt disposal, the current, to have a staged step away from the business. And the kind of key thing for both of these, and the questions that I wanted to ask and for you guys to consider, is why are you doing what you do? What are you trying to achieve, and what's the end game, whether that's a year away or 20 years away? And if you asked your current accountant and finance partner, would they give you the same answers that you would say to yourself now? And if not, why? Because it should be a very joined up decision between the partners you work with and what you're trying to achieve yourself. If you're not all pulling in the same direction, then it's going to add years onto getting where you're trying to go. They were the kind of the main points that I wanted to cover, and I'm not sure whether or not my colleague Mark wants to jump in with anything, or whether or not Catherine wants to talk about some share advice and EMIs.
Messing up your hallway, but
someone messing up someone's hallway. I'm very happy to jump in and just say a few words. And first of all, thanks for that, Sam, and also Laurence, for the introduction. I'm working with Sam and Laurence and the gang at This Accounts Co. And I think I'm not an accountant. I'm not technically in that space like Catherine and Sam are. But what I've realised, having come from more of a consumer-facing background, is within the accountancy world, it is often a once-in-a-year relationship. It is very occasional, and there is no real alliance between two fairly important functions, obviously the leadership team and also finance. And I think what we're striving to do, both at Blue Peak and with This Accounts, is blur that barrier and act as trusted advisors within people's businesses. And we've actually interestingly got another case at the moment where the company's looking to raise between 5 and 10 million quid at the moment, but everything they're doing on the finance side is absolute budget, and they are trying to cut costs in the wrong areas. And I think that will have massive impact, because when the investors are looking at the numbers, they will see that it's budget and it's really tight, and there'll be lots of information that is missing. So I think certainly there are some key things that obviously Sam has mentioned, and I would go on to say that as Blue Peak and working with This Accounts, there's an awful lot else we can do. We do payroll, we do international payments, we do personal tax as well, and I think it's important that people look at their tax position on an annualized basis. And I think, Sam, it's something that also you do. Is to review people's tax positions on an annualized basis in advance of year end. So I think I would also sort of encourage Catherine to say a few words about the whole EMI and share piece, if you're okay with that, Catherine.
Yeah, absolutely. So I guess sort of part of having a business that you've set up or that you're growing is the end result. And the analogy that I always use is cake, because most people like cake. I like cake. We talk to business owners about giving shares in the company away. And they often say, well, why would I kind of give shares away to other people in the team? And I think the answer is, if you keep all of the shares yourself, then you maybe have a cupcake at the end of it, which is very nice. But actually, if you can give a few slices away to other people, you then align them with you as a business owner, because they are a potential shareholder in the future. So you'll find they'll work slightly differently as employees, because they actually want to grow the business in the same way as you. And so you kind of take the relationship away from being, well, I'm coming to work 9 to 5 and I'm just doing what I've got to do, to more forward thinking. And so actually with that model, you get a bigger cake at the end of it. So yes, you've given a few slices away, but you've actually got a very large chocolate gâteau. And I think share plans is something for another session because there's loads of information. But what we do is we'll often work with companies that are wanting to grow and put something in so that everybody is aligned as a potential shareholder. One thing I'd say is some businesses we work with have actually already got into that mindset, and they go down the route of saying, yes, that's the right thing to do, and they give the shares to the employees. That isn't best practice because there is actually usually a tax charge at that point that the individual will need to pay. And that doesn't particularly go down well when we have to say, but you've given them a tax liability. So the way that we would normally work it is that we give the employees the right to get shares in the future. And to protect the business, it could be if you're going towards an exit, so you want to sell the business, the plan can come to fruition at the point of exit. So it means you're not actually giving shares to your employees now. So you're not diluting yourself or any other shareholders now. If those individuals were to leave the business, or you had a fallout, or you weren't going in the same direction, they don't have the shares. They would just fall away. So it really does protect the business, but you're still incentivizing those people to push you towards that exit that you may be wanting. The one that we predominantly try to get companies set up with is something called an enterprise management incentive scheme. It's also called an EMI, and that's got brilliant tax advantages. So at the time of an exit, the individual pays capital gains tax on what they receive. So there's no employer's national insurance to worry about. And actually, assuming that we've still got business asset taper relief or entrepreneurs relief available, they would actually pay at 10%. So you're giving them something of value and they're paying very little tax for it. The company gets a corporation tax deduction and doesn't have employer NIC. So it's a really neat way of doing that. So happy to pick up conversations with any of you that might be thinking whether this is a route for you.
Thanks, Catherine. Thanks, everyone. There's some real value in amongst what we've heard today, particularly around EMI share options. I speak to lots and lots of founders who, may not be looking at taking or building a team and doing so with, the most tax efficient way, best way of doing things without any money in the bank. And I think EMI share options and other options are best to speak to. But again, when you speak to founders, a lot can go wrong at this moment in time, and not getting the right advice, speaking to the wrong people can often cause you problems, particularly at exit. That can often be an issue. Do you find that, Catherine?
Yeah, that's a really good point, Ollie. So before I set up Blue Peak with the team, I used to be in one of the big 4 accountancy firms, and my area of specialism was share plans. So I used to sit on the other side of the fence when a large business was buying a smaller business. I would do the due diligence in looking at, is there any tax exposure? And share plans is one of the ones that people that do the job that I used to do hone in on, because if the paperwork's not quite right, there are lots of little areas you can fall in. And it's not to say that lawyers don't do a great job if they put a share plan in, but I think if you're looking at that arrangement, or maybe even some of the online ones where they say, click a button, you've got a share plan, those important tax things aren't considered. So it's a word of caution: do it properly if you're going to do it, so that you don't get to an exit and find it all falls flat.
It is worth adding to that as well that we've been involved in 3 purchases or sales this year so far, and shares have been a red flag in all 3 of them. There have been issues in all of them as part of that process.
Yeah, there's a lot of, Catherine, do you think it's worth talking about some of the issues with other providers doing EMI kind of through AI and software, and how it doesn't actually perform when you need it to?
Yes, absolutely. So we've got one client at the moment, and when we're talking about our clients, you know, Sam's mentioning the fall down in the shares. I would add that we didn't put those plans in, I'd like to say. So we've got one at the moment that went on an online platform, and the very important thing about the EMI is getting a valuation agreed with HMRC. And with valuations, I always say there's a tax value that HMRC is concerned about, and we try and get that as low as possible, so the tax is as low as possible. Then you've got your sort of dragon's den valuation of, you know, if you're getting investment in what you're selling your shares for. They're two separate things. But if this tax valuation isn't done correctly, then when it gets to exit, you may have issues. And the client we're working with at the moment used an online platform, which is kind of, you put information in, click a button, it does a valuation, and you send it to HMRC. And the steer we're getting from HMRC at the moment is they're aware that happens and they don't like it. So we're expecting to see a bit of a crackdown on that. And I think the other point as well is around the order of the paperwork. So there was a business we worked with last year where they'd done the share plan, but they hadn't got the order of events right. And it was a bit of a paper exercise, but they'd submitted things to Companies House in the wrong order. And so actually there was a really large possibility the deal wouldn't go through. But we managed to work our way around it. So those are the sorts of things that you don't want to happen at exit, because you're very busy doing other parts of the deal. You don't want to be worrying about your shares.
Yeah, it's a really, just, I think it's very fascinating. My meeting this afternoon is with a mutual client who Catherine and the team are helping with the share advice. A lot of things have been done wrong, and you have to unpick certain parts on the exit. And unfortunately, the people that suffer are the founders, the people who built the business. So always worth getting a second opinion. And I think just being wary of a lot of accountancy tech platforms out there, which are, you know, at the end of the day, we all have one person to keep happy, and that's the revenue. And if they're not buying this stuff, then it's not necessarily viable. And you've seen it in all sorts of tax reliefs in R&D as well, particularly. They've cracked down on that. So I think going back to kind of in-person advice is probably the safest bet, because at least you know who you're dealing with, and there's a proper calculation behind it of what that practitioner has come up with, and hopefully also accountable for it. You know, they're insured for the advice that they give, whereas a lot of the platforms out there, you don't really know, you know, who's behind it, or how you can protect yourself if it goes wrong.
Thanks, Laurence. Any questions for the Blue Peak team today and this R&D? Any questions in the room? Any specific relating to your businesses or what you're looking to do? You've got an exit plan at some point in the future? Louisa.
Hey, very quick one. There's reporting all the time about crackdowns on the scope of R&D and software and blah, 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 blah. Are you seeing a significant impact on the supposed restrictions in what constitutes R&D? And do you think that there is, in, for example, the software space, in some cases, a perhaps maybe don't waste time on it because of these changes, or is it just hot air?
Well, software has definitely gotten harder. Unfortunately, there was a lot of companies claiming that, you know, didn't have really anything eligible. We have a process which we put the clients through. It's quite rigid on the software claims, and we've had success with them. The worry at the moment is the balance between what that claim might be worth and how much time it may take with a revenue inquiry. So what we do is on a case-by-case basis is weigh it up and see whether it's you know, it's worth going after. So a claim of say 25,000 might be worth it for the client and for the advisor, but when it's sort of slightly below that, you know, it might not be worth it to spend 20 hours of HMRC going through everything line by line. But in saying that, the inquiries seem to have certainly rolled back a lot. There were obviously a number of other people running firms who have a lot of inquiries, and we haven't seen any for the last few months. So it has settled down a lot, and the revenue are struggling to deal with their own backlog of compliance checks. But it's not to say that unfortunately they might, not come back and start the same thing again. So I think at the moment, regrettably, look at it on a risk reward basis of time, and make sure if you are doing a claim, sign with an advisor that's insured for the advice that they give, and that they give sight of the written report to you before it goes to the revenue, and involve you in the process, good or bad, whether it's qualifying in or qualifying out.
Can I add to this from a purely accounting point of view, because we don't set ourselves out to be R&D tax specialists, which is why we work with Laurence and the team. So we do see a lot of R&D credits come through on some of our clients that use other advisors. And I'd say that the movement from HMRC, in our view, is that there have been a lot of advisors out there that, because they're incentivized to put through as much expense as possible because they get a percentage of it back, some of the claims we've seen on our clients, we've said we're not really that sure about these all being valid claims. And so there have been some, I don't know, possibly cowboy organizations out there that would just put anything and everything into the claim. And I think that's what has moved HMRC towards the crackdowns. So Laurence is absolutely right. I think it comes down to the advisor. And if you're having a sensible conversation with somebody that is a reputable firm, they'll give you that balance. Some of the firms out there historically would have put everything into the claim and hoped for the best.
Yeah, but I think actually the recent changes the revenue have made now are helping a lot. So you now have to make clear who's written the report and who's behind it, whereas you used to be able to sort of hand over documents and they could submit them and it wasn't clear who wrote the report. So the revenue had an awful time kind of regulating it. But they've made some new changes, and a lot of those changes have moved a lot of advisors out of the space who were frankly running amok with it. And in doing so, it's much easier for them to see, okay, who wrote it, okay, the compliance box is being ticked. But in general, you always have the same issue with the R&D claims, is that, if it is a technical advance or something new, it's not the easiest thing to write up and put an argument across. And it's also, from the revenues point of view, it's new to them as well. So it's trying to find that balance between the technical details that you need in the report to justify the advances, and also making it sort of accessible, because it is a civil servant who's reviewing it at the end of the day, and they don't have to be an expert in engineering in any field or computer science, but they do need to be able to see, okay, yeah, we have compliance with the guidelines for the following reasons. So it's a bit of an art form. We do it manually. Deal that Sam talked about, we worked on for a mutual client. It was a much larger deal than I think we initially expected, because it was they had some licenses in the company on software. It's still a valuable space, but ultimately it's just one that you just dogmatically go through step by step, keep the client in the loop and see if it's worth mutually going after.
Thanks, Louisa. Any last questions for the Blue Peak team this morning?
And it's not really a question, but it's something that I would probably want to follow up on. We've spoke potentially in our business about EMI schemes, once we get funded, and potentially to use as a way to keep salaries a little bit lower, to keep salaries in check, but with the option of EMI share options. But one of the concerns is, well, if you do it post investment, then obviously you're giving them share options at a much higher value than we're taking our shares at pre-investment. Does that have major tax implications on the employees? So that's probably something that I need to take up afterwards.
Yeah, certainly. I think your question is one that we can definitely speak separately, but I think it's an interesting point that would be worth sharing more broadly. So we do say with an EMI, try and put it in as early as possible so that you get the value as low as you possibly can, because that means that you first off don't need to give people so many shares maybe, and secondly the tax value is lower. But I would say when you do get the investment in, if you're selling your shares for £5 a share, it doesn't mean the value for the EMI is £5, because what we do is we go through reducing that value for tax purposes to take into account things like it's a private company, the shares are under option, the individuals couldn't sell them. So there will always typically be a separate value, but the earlier the better.